Carol, we received a number of questions related to the banking outlook, headwinds in that sector. One said, and I'm quoting here, I heard Kyle Bass on TV last week saying the U.S. banking industry will lose hundreds of billions, that's with a B, billions of dollars from exposure to the office market, unquote. This is one of several real estate questions that we received. So what's your take, and how does it affect banks, real estate investors, and the economy at large and in general?
Yeah, I mean, there's no doubt that the banking system is still on edge. I think the Fed has done a lot of things to try to stabilize it. They've had these programs where they go in and they're backstopping these treasuries that have lost a lot of value. But, they can't account for everything. And I do think in the commercial real estate sector, particularly as was noted in the question, that office piece of it, there is still a lot of fallout to be had. We still don't have people going back to work. The occupancy rates are down. You have these crazy increased costs of refinancing, and regional banks do have a lot of exposure. So some of them, but that's when you look at like who's more at risk. The big banks or the regional banks. It certainly is the regional banks. Yeah. So what's going to happen? Janet Yellen warned of future bank quote unquote mergers. Forced mergers. I do think that we're not out of the woods on that yet. And, depending on how that is presented, that could create some more panic and shake confidence in the system. There's been just too much that's gone on for too long that, as I said, haven't really kind of fully worked its way through. The Fed's done more than they probably should have to stabilize this. So, I think it's still a real headwind.
All right, so let me piggyback on that. There's this environment, unstable banking system is the way you described it. How detrimental will, if rates do happen, if rate hikes do happen, further rate hikes do happen, how detrimental will they be?
So this is probably talk about things that you can talk about at cocktail parties with people who care about the economy. One of the weirdest things that has happened when you, and I talk about this, by the way, in my next Gold Line newsletter. So if you want to get a deeper dive, you can get all the specifics on this. But, what is tighter monetary policy supposed to do, right? When they raise interest rates, they're shrinking the balance sheets via QT. The whole point of that is to, slow things down, including slowing down lending, bank lending. Now, one of the economic commentators that I follow, who I like a lot, is a gentleman by the name of Luke Groman. He is with FFTT LLC. And one of the things that he explored in a recent piece is that sort of the opposite pattern is happening. He quoted another economist that looked at the 4 weeks that were leading up to the middle of August report on bank loans. And while you think that these rising interest rates would say, okay, well, we're not going to lend, that's what they're supposed to do, they actually expanded slightly faster than the rate during the 2018 to 2019 period, the pre-COVID period. So why would lending be picking up in a cycle where they're supposed to be tightening? Are they just disregarding things the same way that the government is, right? So Luke Rahman also talked to this hedge fund manager from who used to work in emerging markets. And he had noted this as a phenomenon, is that when you get these massive rate hikes after inflation, and basically you have these banks that have loans on their balance sheet at very low interest rates. And so as rates go up, they're like, well, to make our balance sheets look better, we should just put out a lot of loans at these higher rates so that our average rates move up. And so what is happening is that the rates, instead of choking off that lending, have actually been expanding the lending, which is just crazy. Now, obviously, again, that's probably not a long-term thing, it's a short-term phenomenon, but again, goes to the point that what the Fed has been doing really hasn't made its way through the economy, even to the banks, which we know have had some fallout. So, the banks have been trying to shore up their balance sheets. They have been leaning on the Fed, but we have had this, crazy cycle and duration of intervention. So again, I don't know that the Fed can save everything, and it's definitely something to watch.